We should be live, which I believe we are, right? Does it seem live? Okay, great. So for those who are just logging in who haven't seen our podcast, or the unfortunate situation of not having had benefited from Real Fridays, this is Real Fridays every Friday at 12:30. We're industry experts, are led by myself, a retail mortgage banking executive, an expert on retail mortgage lending, and Brock Cassidy, who's a real estate tech entrepreneur, innovator, chief revenue officer over at NewZip, and Jeremy Potter, who's what I think to be one of the best legal minds and innovative minds where sort of the law and innovative technologies sort of meet, come together. I think he's a phenomenal resource for any company and tech company. Where we come together, we talk about all things mortgage, housing, and real estate. Just talk about, not quite insider information from a trading perspective, but more inside information on what's happening feet on the street in the business that I think most tech investors, most vendors just don't necessarily, they're not quite as in tune with. And so we are super lucky to have OwnUp. I'm a huge fan of OwnUp. It's a great company. Real happy that Will Donovan, you're head of business development, right, Will?
Yeah, I head up the lender network here.
Oh, the lender network. Okay. Which is business development of the lender channel within OwnUp?
Yeah. So we're a marketplace. So anything that any of the lead flow or product types that end up being purchased by lenders is sort of headed by me.
So it's only mortgage lending, is that right? I mean, you're not in auto or anything else. It's only for mortgage leads.
Yeah. I mean, I think at the when we first kicked off, we thought about like personal finance as a whole, but instead of taking the SoFi approach where you start at the smaller ticket items and work up, we sort of started with mortgage and are still in mortgage, and ultimately we'll probably sort of funnel downwards.
Yeah. No, that's great. Good that appreciate Jeremy logging in. This is perfect. Now we have
hey, well, good to see you.
We have a true foursome here, which is perfect. So just before we dive right into OwnUp, I'd love to just get a read from both Brock and from Jeremy, and you will too. Just maybe going in that order, around what are some of the news or some of the headlines of the week that sort of stood out, some of the market events or sort of headlines, because there's some themes that I'm seeing percolating, throughout the week, culminating into today.
Well, there's a lot of I don't know if legal is the right word. There's a lot of legislative confusion, I think, around a few different things with our new president-elect and incoming regime. I know the NAR settlement is very in question. That comes up for me every day, 10 times. I don't know that there's any real news on it other than different parts of the government and incoming regime kind of bickering amongst themselves. But it is kind of bringing into question these changes that people have been, including NewZip, have been working on all year. So that's an interesting one. And there has been a ton of like actual economic data coming out that I think has been fairly good, if not shocking. I think, inflation's a little, rates have risen a little bit. Inflation's risen a little bit. It sounds like we're still getting our rate cut and everything, but maybe not the rate drops that people were hoping for next year penciled in as heavily as they were. Rick, a whole lot more about that than me, but those are a couple of things I've been keeping my eyes on. And then, just a ton of end of year wrap up stuff going on. Lots of earnings, lots of announcements, and everyone has a minute to kind of catch up, I think.
That's great. What about you, Jeremy?
Yeah, I was just trying to think of I didn't catch many of the headlines, so mine are going to be fairly like what I was focused on or asked about this week.
I think that's perfect.
But I was going to say that, and then I have one exception or one caveat to that, which is, we had talked a lot on this podcast about the title waiver pilot, as it's called. I don't think that's even the right terminology for it, to be perfectly honest, but that's kind of how it's become known on the street. But alternative products approved by the GSEs to avoid a lender's title policy. And, having some lenders come out confirmed publicly in Housing Wire as participating, I think is probably a step that shows the GSEs still want to work on it. I think
is that the? I'm going to make sure I'm tracking. Is that like the AOL type stuff, replacing full title work basically on certain products? Is that what you're talking about?
I'm glad you asked, because that's the question I get the most, that exact question. And what I will tell you is AOLs were already allowed by the GSEs for like 30 years.
Yeah.
And a couple of different firms just sort of dusted off the allowance and brought it back and made it new for this market. And so what this was not a lender's title policy or an AOL. It was literally submit data, and you don't need either. So it's a third category, but it's definitely in the same category as AOLs because it's not a lender's title policy.
Less than an ARM, less than an AOL.
Yeah. Is a good way to look at it. Yes. So very fair question, because that's one that everybody's asking. And I think it's like one of those, it was a poorly kept secret who was doing it, but the fact that it's now in print means, okay, we know lenders are doing it, and now their competitors will take a look at it. And I think that does relate a little bit to the one big thing I was talking about a lot this week, which is what you mentioned, Brock, GSE reform. Everybody trying to read the between the lines and trying to get an understanding. What's the intel? How quickly is it going to happen? I mean, we all agree there is going to be major changes to the conservatorship of Fannie and Freddie. I think the biggest question was, you talk to some people and they're like, first 6 months, it's all going to change. Other people are like, it's probably going to take 2 years because it's a highly complex legal and regulatory process. And so we're hoping that in 2 years we can do it. So I think that was probably my biggest conversation of the week. What was going to happen with Fannie and Freddie. And then, the last thing third one, everybody spent a bunch of money on servicing, and we talked all of 2024 about retention as it relates to servicing. But over the past few years, there's also been a bunch of money spent on loss mitigation and foreclosure type services, default type services. But we've continued to have relatively low defaults, historically speaking. And so I think there's a big question of like, how much more cost and pain do I continue to endure waiting for these defaults that I'm told are coming, but they didn't come in 2023 and they didn't come in 2024. And now you're telling me they're going to come in 2025, but I've been spending on consumer protections and technology around loss mitigation and default. And now that money's out the door and I'm not getting it back because it isn't happening. So I
saw data actually yesterday that's happening even less than, it was expected to be low, and it's even substantially lower in like Q4.
That's interesting.
Yeah.
So I think that's a real question, is like, we keep spending money on stuff, predicting, trying to be ready. In fact, trying to be good partners to consumers. I want to have it ready if it's needed, and it just hasn't been needed yet. And so that's a cost. That's a pretty major cost. And I don't know what to say about it other than I think people are looking at it, but it's going to be hard to spend money in that area going forward until somebody sees a need, I think, is kind of my takeaway.
Yeah, a couple of things that I've been watching pretty closely. A couple of things. One is the servicing default risk, like how much production volume is sort of at risk due to high levels of consumer debt, and in the overall trends around consumers that are falling behind on their mortgage payments, and which servicers, which independent mortgage banks potentially could be at the greatest risk of either additional runoff to some degree of other organizations, competing for that business and taking them off their books, but then getting them into a right-sized program, or just simply falling behind, period. And then the second one I'm following, and Greg actually highlighted this in a post just about 40 minutes ago, basically stating that about 25% of all consumers are really above 5%, which is really what we're seeing is a fairly normalized evolution of the business, that as rates sort of shot up so quickly, it kind of stalled the market out. But now that there's enough sort of rate diversification as far as where people are at, it'll as rates go down, and the hope is they can go down to like sub 6, maybe mid 5s to high 5s. nobody has that forecast as of right now. I mean, I think the consensus is 6.25, 6 1/8, 6.5. Like it kind of fluctuates depending upon Fannie's forecast or Freddie's or the MBA's. But if we can get probably mid 5s, I think a lot we'll start tapping into this segment here, the 4 to 5% segment, which is a lot of loans. That potentially could make this jump and put even that much more, almost 40%, 35-40% of all loans could be potentially at a place where they'd either trade up for a new home or they would refinance what they have.
So
that would be tremendously good news for our friend Will.
that's a perfect segue. I don't know, Will, do you feel like you are able to see kind of the tip of the spear that Rick just described? Like, and I'll ask the question this way. How many consumers don't actually know if they're going to refi or purchase a new house when they start to dig in? Like, that would be a really cool but weird kind of data point to try to figure out in your world of like when somebody goes out, starts discovering, they usually pop onto your radar, right? And what you're doing. How do we know? How many people actually aren't sure if they're cashing out or moving?
Yeah, I mean, I think most people don't know. Like
Okay.
when we see people that flow through, when you look at the like questionnaire flows for purchase, refi, and then the sort of bifurcation of lowering your rate or taking cash out, and the sort of like what you're using cash out for, if you sort of know that that's what you want to do, it's pretty much all over the place. And even the people, like, we have sort of an intimate way of understanding like questionnaire flows because we have a concierge team similar to Brock's NewsZip folks, where some portion of our traffic is getting exposed to the concierge team, and the amount of times where you see discrepancies between what's filled out in a questionnaire and what a customer thinks versus once they've spoken to someone and actually been educated about sort of like what their alternatives are, the sort of the variations from what's input to what is sort of like then been decided before going to a lender, it widens in an environment like we're in today.
Yeah, I always think that companies like OwnUp do have that like crystal ball a little bit of like what you get data a little while before lenders, a long while before real estate agents, I think, and NewsZip's trying to be one of the very early recipients and identifiers of that data too, and that's kind of what Will and I have talked about a lot. So, but do you feel that way, Will? That I think Jeremy asked a version of that question, but do you think that you have kind of like insight that that OwnUp, the company, or you, the person, have insight into what's coming in the next few months a little earlier than other people with where you sit?
Yes and no. I mean, like in terms of like, if you're talking about like what the customer thinks they're going to do in the future, I would say.
Well, I guess it's twofold. You have that, and then you have what lenders are planning to do.
I would say I have a better view of like what marketing plans look like and what that ultimately means that they believe is going to happen in Q1 and Q2 than I do like what customers are going to do. Like
sure.
If I had that crystal ball, we probably wouldn't be on the phone right now. But yeah, I mean, I think lenders broadly speaking are pretty bullish on Q1 and just getting out of the typical doldrums of Q4, and it seems like people are, at least within the consumer direct space, are staffing up pretty decent amount. And I think we've been in a purchase market for long enough that people are starting to get smarter and smarter about purchase as it relates to direct to consumer mortgage, which I think is one positive that's come out of an unfortunate spike in rates and then sort of staying high.
We had a great 10 days of refi in September. Don't discount it.
Yeah. But I think like people are, whether they're building out sort of JVs with real estate brokerages within the consumer direct space, or using NewZip or equivalents, it's becoming sort of common practice. Like, you have to have a real estate solution, or you're just not going to be good at purchase at scale.
What for one thing, you guys are really a purchase driven lead operation, right? So I mean, the market swinging toward the pendulum of purchase to some degree, it really falls into the strategy of supporting good quality, pre-qualified, mortgage ready, purchase driven leads, right?
Yeah, I would say we mirror the macro more than anything. I think, like, when you compare us against other lead generation sources, I would say we skew purchase, because we're not like like Tree purposely targets like cash out and HELOC customers, and sort of that's their sort of like bread and butter and what they're built off of. We are just marketing to sort of mortgage folks and creating sort of like hey, here's a marketplace for you to get smarter and get access to vetted lender network. And then we get sort of a macro distribution of purchase and refi. But like in 2020, 2021, we were probably 85% refi, 15%.
Oh, wow.
And now we're like almost the exact inverse of that in terms of units.
Yeah. So I'm gonna hand it over to Jeremy real quick, but I do want to comment. Your office needs some work. Will, you have no art, you have nothing behind you. You look like you're in a stairwell of a hotel.
I'm in a CIC, which is like a WeWork equivalent.
Oh, got it. Well,
that's even worse. That,
you should save money.
Yeah, that makes it worse.
Do you guys know what the real estate costs in Boston? He's saving money. This is a shrewd operator here.
Beautiful Providence here,
I heard Will was moving back to Boston shortly, but he hasn't reached out for a NewZip agent just yet.
Yeah. I'll be reaching out for that in about 30 days.
Excellent.
That's a perfect segue. Wait, so that was going to kind of be my question. So you've been able to see across consumer demand, particularly around purchase, but as you were saying, like refi, purchase, everything. You see the lead gen, you're talking to lenders. I'm really curious if you have your own take on the consumer experience and the consumer themselves. And so the question I would ask, especially in New England, so it's a perfect segue, but I think just in general, it seems to me, and I'm testing this thesis on you, you tell me what you think, that if you can buy a house in 2025, you can very much afford to buy a house. In other words, you're in a good spot financially as a first-time home buyer. And if you can't afford to buy a house, you really can't afford. That we're actually not left with that many people that are sort of like barely on the line. We're really like very healthy shoppers. And then if you can't afford, it seems like you're pretty far away and you're a renter. Is that the shape of the market as you see it, or would you say that's a bit cynical?
Well, I'm jaded because I heard I don't know if it was in another podcast, I heard a similar tune from you previously, so I'm a bit jaded there. But I think one data point that I can say is, there's a lot of traffic that sits at the like 3 to 5% down payment range, and then a decent amount that's 20 to 25, yep. And there's very little that's in like a 10% down payment, which I think isn't exactly what you're suggesting, but is not too far.
Good data point.
From that.
Yeah. And so you could,
Potter, I slightly, I'll throw a little flag on that play. It totally depends. Like, I think it's super regional. I think in New England, 100%. I mean, I live in New York City. It's like that market 100% tracks with what you're saying. Tons of people can't afford to buy and don't. But we have tons of partners in, Sun Belt plus Midwest, Next Belt, that like Ohio particularly, I've seen like really healthy lower price point markets still. We see, I mean, it's obviously
but
more.
I'm saying are those markets seeing 20% down mortgages and cash deals, or are those markets seeing your home possible, home ready?
I think it depends on the lender. I'm biased by what our partners do. Will same maybe. But we have some really good partners that are like that hammer New Zip as part of their first time home buyer, as part of their FHA, VA, low down payment type solutions, because you get those couple $1,000s back on the real estate side of the deal. Well, depending on the price point, you get 50 basis points back. But yeah, we've launched a number of partners recently that are like mostly USDA loans with massive concessions, mostly FHA loans with maxed out concessions. New Zip, in fact, we give the credit back at the closing as a real estate credit. We've been running into situations, especially on FHA deals, where concessions are maxed out. So we literally cannot bring the money to the closing table. So we send a check after closing. So anyway, that's probably the exception that makes your rule, is that it's like so surprising to see those deals, but we are seeing those deals.
Yeah. Okay.
For you, it's probably like that customer base that is lower price points and needs the money. Like that's a lot of the purchase long form lead buyers that are like targeting that sort of like FHA first time home buyer type customer, that like a solution like yours where you can get some liquidity especially at the closing table, it's like massive,
Yeah. Take your $10,000 to close down to $7,000 to close is a pretty big deal. Yeah.
When you go from having $0 after the closing table to $3,000, that's not insignificant.
Yeah, for real. I have one quick follow-up, Rick. I see that you're going to jump in, but this is outside of your day job, but I'm also curious about this. What would you anecdotally look at, or what would you point to if you were trying to determine whether consumers who could afford a home are leaving the market, right? So I'll use the example of unemployment. When we do the unemployment numbers for many years, it was like, I don't have a job. And then somewhere, and I don't know when, somebody on this call probably knows when it happened, but I think it was like in the 90s or something, it became only those looking for a job that don't have a job is now the new definition of unemployed. So if you stop looking for a job for long enough, you're no longer considered unemployed. You're like not searching. And I'm trying to get at what I should be looking at to try to determine how many consumers who can afford a job, who can afford a home, or actually remove themselves from shopping. And are we going to start seeing that in 2025? Or have we already and we don't even know it because we're not looking at what that is? What would you say, just for fun here on Real Fridays, what would we be looking at, or what should we be looking at to say, you know what, people are exiting the shopping market?
Yeah, I mean, I think if you think about just like our flows, like one thing that we haven't looked at it yet, so we don't have the data per se, but like I think if you start with us and then you end up at a lender, they'll pull credit, whether it's soft or hard. Most are leaning soft, and then soon after you get a pre-qual or pre-approval. For people that haven't transacted in 90 to 120 days, a lot of times those people are then just like they're gonna get back and most likely rent again. I think from what we see, and again, it's probably because we skew consumer direct. If you don't transact in like a 3 to 4.5 month window,
you give up.
I modeled that a lot because I just did my 2025 forecasts for New Zip. The highest closing month is month 3 after we receive it, followed by 2 and 4 are also good. 3% of the people that are going to close month 1, right? It takes a while. Month 2, 3, 4, very legitimate amount of the curve, and then it starts dropping. The old rule we had at Rocket when we forecasted this was that 90% of deals that are going to close within the first 6 months, and then 10% will long tail over a really long time. So we would just literally, divide by 0.9, right? Add 10% to whatever happened in the 6 months to get our like cohort value. New Zip is actually a little bit different. And I think it's more the market than the model. I think probably the data would not be different. Probably Rocket's seeing it change too. We see a lot of deals closing month 7, 8, 9. We've closed multiple deals that are 15 to 18 months old recently. Beyond 18 months, I don't know if we've seen any, but like that's tough to even keep track of. But But we continue nurturing them. That's part of our value add. So maybe we're askew again on that. But the old rule that's been in place in this corner of the business of purchase is that 90% of anything that will close in 6 months. But it's gotten a little bit less than that. It's probably like 80% now.
So just as a follow-up to Jeremy's question or point, according to Pew Research, 23%? 24% of renters could afford to buy a home but choose not to, and they choose to rent instead, which is 24% of a total of about 113 million Americans who are renter occupied homes who they're eligible to buy a home, but they're renting for one reason or another. And about 24% of those 113 million are in essence renting by choice for some reason or another. It could be a temporary, which is a huge number.
Yeah, I mean, it's in a lot of markets, it's cheaper to rent, so like that's historically been like, if things are going to be, if your monthly payment's a 1-for-1, like why not buy and get the growth? But in the short term, if you're not going to be somewhere for 3 years and you don't have to tie up a bunch of cash, which is a lot of young people that probably can qualify and have the money.
I always like those calculators of like, how long do you have to be there before it makes more sense, right? And there's like in Detroit, I bought a house year 1 that I moved there because it was like crazy. It was much cheaper to own than it was to rent.
Sure.
But like in New York, the trade-off's like you have to be in New York like over 10 years for it to make sense. In Boston, it's probably like 8 or something. But in most markets, it's probably like 3, 4, 5 years, like you were saying. But it's crazy how much it changes. And we got a question or a comment from Michael Zhao, who does the Mike and Mike show or Mic'd Up show. Forget what the current name is. Sorry, Mike. But this is a really good point too. And there are certain parts of the market where the property tax and insurance, and I'll throw HOA in there too, are just like a total departure from the costs that people can pay renting. And so it's really difficult for whether like lock-in effect, I think is a great term that describes the mortgage piece, but there's a lot of other pieces to it too. A lot of other costs.
Yeah. I mean, I think this is well timed for the conversation because it just adds another variable of uncertainty. So, Will mentioned, I don't know if I'm going to be there for 3 years or more. I think there's an actual, and not to make it too philosophical, but I think there's an even more umbrella of like, there's a lot of uncertainty now, economically speaking. I don't know how it's going to play out to my income. I also don't know, as this millennial generation moves into these life milestones and phases, I also don't know if I'm going to be there for 3 years to the point. And now further, I don't even know if my monthly payment's my monthly payment anymore, because it used to be these small adjustments and now it's these major adjustments. I was just telling somebody the other day, Brock, this isn't going to surprise you, but I was telling some people, a month, my fixed rate mortgage has gone up $600 since I bought the house. Like, that's insane.
That is wild.
And I'm probably delinquent on checking why. And like, my friends at Covered Insurance are gonna be like, why aren't you shopping your insurance? And why aren't you challenging your tax assessment?
It's probably mostly your home.
Challenge your tax assessment. But like, it's probably mostly taxes, right? And so my point isn't like whether or not that matters to me. I think my bigger point is, if we keep baking in uncertainty in these stories, and and the market keeps embracing stories about HOI uncertainty and climate risk and taxes and all this stuff, I think we're really systematically breaking down all the reasons you should buy a house. And and we keep banking on this assumption that like it's such a strong motivator that we can still throw out 7 different stories about why you shouldn't, and somehow that isn't going to matter. And I say the industry.
It's gotten a lot harder to sort of like conceptualize like renting is throwing away money and owning is like the obvious choice when you're required to throw away all that money on other costs on owning. Yeah.
Like I'll ask you, Brock, if you wanted to buy a $1.5 million house, right, in one of the metro areas that we're
another
talking about. Another one. Yeah,
Yeah.
he's adding to his portfolio, let's say.
Yeah.
Right. So
Oh,
yeah. So you're gonna put $300,000 to work, $400,000 to work in 2025. Are you locking up that cash in a house?
Apparently, yeah, I guess so. I mean, it's so different. Like I rent in New York, but I bought a house in Detroit. I owned it for a long time. Sold it fairly recently, actually. I will buy a house the minute I don't live in New York, I think. But New York's crazy. It's like that trade-off calculator is like, instead of being like, if you stay more than 2 years, it makes sense. It's like legitimately probably more than 10 years. HOA may be more expensive than rent, like on top of insurance, taxes, all like. I moved to New York with the intention to buy. I mean, I was working at Rocket Mortgage in an executive role. Like everyone like thought it was insane that that's what you do. And I did the math on, I don't know, 100 properties my first year in New York. And I was like, and that was when rates were, 4% or something, 3%. And it wasn't even close to coming out right for my situation. It was crazy. But anywhere else almost in the country, other than maybe where Mike is out in California, is similar maybe, but yeah, it's pretty wild. So there's actually an interesting cohort of people in my sort of demographic living in New York, Boston, San Francisco, what have you, that are either buying investment properties, vacation properties, or both, while renting in the city. And that's probably what I would do, actually.
Yeah.
More or less what I have done.
So what is like OwnUp's plan moving forward? I mean, it seems like lead distribution, it's a saturated space, right? It's difficult. It's very price sensitive. And I don't know. It just seems like it's a very crowded field. So how do you differentiate yourself? Is it just purely in the quality of the leads, as they all sort of will make the case? Is there another direction that you add to it? Is there other services you piggyback onto the lead? Like where does OwnUp go from here?
Yeah. I think it's hard to argue that it's not saturated and that there's not a lot of hot air in the lead space. I think the two things that I think we drive the most value from are our concierge team, especially in a purchase market. If you think about who we're servicing, largely it's consumer direct lenders, or more and more retail, like individual branches are sort of operating as like hybrid retail CD shops. But in a refi market, you don't like the benefit of having someone talk to a lead before it goes to a lender is limited, because in a refi market, all they want to do is see if I can save money. It's pretty transactional and there's not much there. In a purchase market, when a LO that's sitting in a call center gets a lead, it's very hard to communicate the benefit that you have over someone else in the first call. And what we've seen is, by sending purchase traffic to the concierge team first, doing things like, educating the borrower, building rapport, gaining trust around the lender network, then we'll run soft credit on them. We'll verify income and assets verbally. We'll essentially get a customer to like an AUS approve eligible proxy, and then intro them to a lender. So it does a bunch of things. It takes the sales burden off of the LO. It builds the intent of the consumer, because they feel much more control of their consumer experience. And it takes something from maybe being able to get pre-approved at a 5% rate in a typical sort of like long form lead gen play to 40%. Like we even see it with the biggest players. You guys talk a lot about Rocket, like Rocket still has like an 8 times multiplier on pre-approval rate issued in a fully digital long form experience to leads that hit our concierge team first and then go. Same population of customers. The only thing that's different is they've interacted with our home advisor team.
And those folks are licensed as loan officers so that they can have that conversation. Is that right?
Yeah, they are. So they're all licensed LOs. They're pretty much like highly skilled customer service like liaison folks. And the second big thing that I think differentiates us is, if we do 20,000 leads in a month, we'll get reporting back from like 17.5 or 18,000 of them. So we've built a lot of machine learning models that, when a customer comes and hits and fills out a questionnaire, we know its propensity to convert on a sort of lender network, a full lender network basis, but then on a lender by lender basis. So you want to position that customer to a specific lender that has the highest likelihood of converting that customer if everyone's paying you the same amount, which, because of compliance and everything else, pretty much everyone has to pay the same amount. And that drives up conversion and sort of makes the leads more valuable. So I think those are really the two things: the data and machine learning that gets applied, and then the concierge team are sort of like the two biggest value drivers to performance and sort of what ultimately drives budget increases.
So what do you go ahead?
I was gonna say, so a lender, sort of playing that back to you. So a lender can go to OwnUp with a little more of like a bespoke request of like, I want clients that look like only this with this type of intent and this type of timeline. Not that you can't do that elsewhere, but I think the licensed human, having already had so much conversation with them, allows that to even go a notch further. So is that kind of how you position it?
Yeah. I mean, like we still have refi traffic that is fully digital, and we still have purchase traffic that's fully digital. Sure. But yeah, I would say, the beauty of our platform is that there's a lead type for everyone. Like we have the long form, like call center type leads. We have, leads that talk to the concierge team and then go to a lender. We have like even retail lenders buying those leads. We have brokers buying them. We have consumer direct lenders buying them. So, I think there's something for everyone there. And then on the, lenders that are more attuned to like buying from like a rate table type provider, like a Bankrate or a Nerd Wallet, we have accepted offer leads. So people that come through with signed contracts makes up close to 15% of our total purchase traffic. Those convert at 10% of lead, 10% from lead to lock, which is very high, especially in the purchase space. So I think there's the benefit of us is there's a home for everyone. Like we've built a lead marketplace that can service whatever you're looking for, whether you're Rocket trying to buy as many leads as you humanly possibly can in a single day, or if you're a 3-man branch looking to get sort of high intent traffic in a specific market. Yeah,
that sounds like a really valuable differentiator. I mean, Potter and I were skewed very early in my career. I guess he worked a few other lenders before Rocket, but yeah, the approach of buying every lead is not for everyone. It's for Rocket, that's fine. Yeah, makes sense. That's cool. I'll give a shout out too. We share a few partners, and occasionally have opportunities to refer and use it back and forth every now and then. And we really do see very, very high quality on those leads coming through from tied to OwnUp and partners tied to OwnUp that are whether it's OwnUp business or not. I think it's like good partners probably go to OwnUp, good lenders.
Do you have any data on what your conversion rates are, Will, or how do you like? How would you like provide some kind of reflection of the success of what OwnUp does for lenders?
Yeah, so we have very granular data into conversion. So before we launch anyone, we give you sort of like a lead. You give us, hey, this is what we want to buy, and we'll give you sort of like a expected conversion down. So for things like purchase leads that touch the concierge team, those are somewhere between 8 and 10% lead to lock. Accepted offer leads that come through with a signed contract. Granted, it sort of depends, but mostly sort of lower margin groups are buying that. Those are right around 10, 11% lead to lock. Our long form purchase stuff that is sort of like mid-funnel purchase, 1 to 5 months. That's typically like right around 1.5 to 2%. And, the the costs of all of these things vary. And then refi traffic has varied anywhere from 5 to 10%. I would say we are closer to the 5% range right now, just given where rates are and have risen to. But yeah, we have really, I think that's some of the strongest thing. Like we give very transparent expectations of what's going to get achieved, and we're very confident that we can deliver what we say we're going to deliver. And yeah,
I think that's one of the key things. I think that's
those are competitive networks. But go ahead, Jeremy.
No, man, I didn't want to cut you off. That was great. Do you have a question?
No. I actually was just saying, go ahead, Jeremy, because I think on the lead side, you have a better sort of barometer on the effectiveness of those conversion rates. It was my way of handing it off to you.
No, that was perfect. I want to kind of flip it, Will, back to the consumer. So you're talking about setting expectations with the lender. And one of the things I'm always curious about, we're seeing a trend more and more. I like to think of it as the move left trend, but that's only because almost everybody still defines the origination pipeline as a linear process. And what I mean by it is pulling more data forward, pulling more data up funnel to actually help the consumer understand, shop, certainty. It helps lenders too, but one of the things that's always plagued this industry is how much information you have to give to a lender. So by the time you do, it's really, there's no incentive to shop because you're like, I don't want to do that again just to know what's on, a vague LE or something like that. Can you talk a little bit about what you're seeing, setting expectations for consumers, and what you're seeing about the willingness to provide data up front? Is it what direction is it moving, and how do you see that changing for lenders now and this kind of new data era?
Yeah, I mean, I think there's two different like customer journeys for us. Like we think about things as like pre-consult, like fully digital experiences, and post-consult, having talked to the concierge team. So within the post-consult funnel, everything is very, very laid out and mapped out in a sort of customer-centric way, but then also tailored to like the lender that's picking up the lead once we push it over. So when a customer comes through and talks to a home advisor, they know everything, where they stand, what they qualify for, and then, but more importantly, what's next to come at the lender. So what's their application process like, when and how are they going to be communicated with? And, I think that's just as important as the like upfront education piece, because the LO is going to end up educating them about all of these things, but creating something that's better than going through a long form questionnaire and just saying like, oh, here's your lender, they'll be reaching out to you and you have no control over that. Like, we sort of pride ourselves about like customizing it in a way that gives the consumer a lot of flexibility in terms of like how they're going to be communicated with, but then also what to expect from every specific lender. That's not just like, here's what we hope they're going to do. Like in the onboarding process, it's what they tell us that they're going to do, and we honor.
Right on. I mean, I think that's really strong. I just experienced this in the healthcare industry, and it got me thinking about mortgage, where I called for an appointment to a healthcare provider, and they took a whole bunch of information over the phone, a whole bunch. And then they're like, we're going to send you a link with our patient profile so you can fill that out ahead of time. It was the exact same information that they had asked me on the phone. And then when you arrive day of, you do it a third time. And I was like, this is exactly like the mortgage industry. I was like, they asked me over the phone, I provided everything. They sent me a link, I provided everything. I showed up, they still asked me to provide everything. I was like, so we're not the worst in the world at it. We're just like everybody else. But I feel like
slightly better than health insurance and health insurance.
Yeah, that's our new motto. Yeah. But no, I think, Will, what you just defined is a step way in the right direction to say, hey, by doing this, well, we can set you up for success. And when I say you, I mean both sides of the marketplace. We can set lenders up for success. We can set consumers, and we can stop with this constant process of asking for the same stuff.
Yeah. Yeah, and I think the other thing, we will do things like send intro emails. So, it's not just a payload over. So I think anything that makes the consumer feel more empowered and more in control, I think leads to, better conversion for the lender and better sort of customer satisfaction. Like everything that the customer wants is going to lead to better conversion for the lender who's ultimately paying for the sort of marketing spend.
Is there anything disruptive that you're sort of innovating around or trying to deliver to the market? It sounds like you're just delivering just a better product that everyone else is trying to deliver kind of in the same way, but just better, right? Or improved. Is there something innovative that's just different? That's like, well, when you work with us, this is the one thing that nobody else is doing.
Yeah, I mean, the concept of a concierge team is, there's a couple of like live transfer companies out there that do like refi live transfers, which is really just like, did they pick up the phone? Can they speak? And then we'll three-way in the lender. So I think like the concierge team is fundamentally very, very unique to the market and very disruptive. But I think potentially more powerful than that is the data piece behind it. Like, in a world where there's very little trust in the lead gen space, people have really good success. They'll increase their budget and then they'll have terrible performance. We're very close to being able to provide performance guarantees for lenders that have given us data for long enough. And we have sort of like, okay, we know if they hit, pre-approval rate of 25%, that their loss rate is going to be X. And then ultimately we know that they're sort of going to continue to spend, if not increase spend. So one thing that we're very close to being able to launch is like a guarantee. So if you spend 150 grand with us in a month, your cost per whatever pre-approval credit pull is not to exceed X. And if it does, then you'll get a refund against future spend. And that's ultimately what people want. Like,
yeah, that's pretty slick.
Lenders would rather pay
on the stuff that closes.
Well, yeah, I mean,
with ROI, yeah.
Yeah, but lenders would rather pay if you could guarantee them a cost per lock of $1,750 versus you just give them something that you think is going to cost per lock of $1,250, and some months it will, and most months it doesn't. They almost unanimously would pay for $1,750 just consistently, and that's really what our belief is. Like if you get a repeatable, trustworthy lead provider that can give you deliverable, repeatable results, you'll continue to gain market share, which we have.
Yeah, that's potentially pretty disruptive in the lead gen space. I think there may also be some new products coming out. Are you able to talk about any of that?
Yeah, in the next 30 days, we'll be taking over the mortgage vertical for a very large fintech provider with roughly 80 million monthly active users. And
is this breaking news? Well, come on now, who is it?
No. Well, you'll have to wait for this one, Rick. But yeah, we're very excited about that. We will be the sort of engine that powers their customer base. So you'll be on their website, you'll be within their mobile app, and all of the questionnaire flows, all of the rate tables, all of the lender tables will all be powered by portable own-up questionnaires, portable rate tables. And
so that's kind of just more real estate for what you guys already do, more users for what you already do.
Yeah. I think the exciting piece on that side of the house is their data is most powerful on the sort of refi side of the house, which I think we are very confident in our ability on the purchase side, but we're excited about sort of growing refi market share. And their data is potentially the best data out there to power that.
Nice.
I think it's also a really good indicator too of some of the ways that data relationships, tech relationships, and partnerships are changing and going to change with, what do I want to own versus what do I need to have, and how do I fulfill my customer needs and keep them as much as possible in my world. And so building your company and building your philosophy the way you have, which is we know what we can do and we can put it there, we can put it here, we can do it this way. I mean, I think you've articulated a pretty strong approach that makes that partnership that you just described one of, I think, the stronger that we'll see, but it's going to be one of that, the dominoes start falling. I think that is a trend we'll probably see a lot more of.
Yeah. I think that, you've even seen, even someone as big as like Amazon, like they have a mortgage marketplace for their customers that they're not really they're not delivering that experience, so like that's
Right.
part of that. And I think you'll continue, to your point, to see more and more of that.
Yeah, right on. Well, enjoy outside Providence and your trip back.
Yeah, appreciate it. Thanks for having me on, guys.
Good to see you, Will.
All right.
Talk to you, Will.
Bye.
All right.
Take care.
Yeah.